Money is something that most people take for granted. You wake up, you go to work, you swipe your card, but never stop to ask the question, what is money? So in this video, I'll walk you through how money has evolved throughout history because it hasn't always been paper bills or numbers on a screen. As civilizations got larger, it had to adapt, and every few hundred years, a new form emerged. So let's start at the beginning. In the prehistoric era, people traded through barter, and in small tribes, this worked because everyone knew each other and each person produced one type of good that they could swap with others. For example, a farmer might trade wheat with a shoemaker, but what happens when the farmer already has shoes while the shoemaker still needs food every day? Trade starts to break down, and this mismatch is called the coincidence of wants. Barter could handle simple exchanges in tight-knit groups, but as society started to grow larger and people became more specialized in their work, it started to fall apart. People needed a good that everyone would value at all times, which brings us to humanity's first step towards money. From around 3000 BC, the first evidence of money appears, and as villages grew larger, they needed to find something that was scarce and easy for everyone to recognize. And different cultures chose different things like seashells, beads, and stones. One example of this is wampum beads made from clam shells by Native American tribes. They were difficult and time-consuming to craft and unique in color, which made them trusted in trade. Wampum expanded exchange and allowed tribes to specialize, so hunters could focus on hunting and farmers on farming, knowing they could trade with each other. But when Europeans arrived in the 1600s, they mass-produced glass beads that looked exactly the same. Scarcity collapsed, and so did the trust. These early monies worked in isolated communities, but not across expanding trade networks. Societies needed something tougher, easier to move, and recognized across empires. And this is where coins come in. Coinage marked a turning point, not just in the type of money people used, but in the power dynamics of money itself. Metals like copper, silver, and gold were naturally more scarce, durable, and easier to divide, and this made them far better monies than things like beads or seashells. But unlike collectibles that were adopted from the bottom up, coins were issued from the top down. Governments demanded taxes in them, and armies enforced their use. Controlling coins meant controlling trade, wealth, and political power. The first coins appeared around 600 BC in Lydia, made of silver and gold. And their value wasn't just in the metal, it was standardized by the stamp of authority that made them universally recognizable. And coins spread quickly across empires and trade routes, making them the foundation of taxation and trade. But rulers abused this power. In Rome, the silver denarius began as almost pure silver. Over time, emperors clipped and diluted the coins to stretch the supply and enrich themselves. By the 3rd century AD, the denarius had less than 5% silver left. Soldiers refused to accept them, demanding gold instead. Without an army to enforce it, trust in the money collapsed, and Rome's economy collapsed with it. After Rome fell in 476 AD, Europe fractured, and coins still circulated, but during the Dark Ages, trade shrank, and there was very little real innovation in money for centuries. It wasn't until the Renaissance that accounting and banking pushed money into a new era. By the 12 and 1300s, merchants were shipping goods across the Mediterranean and beyond. But this created a new problem. How do you track payments over long distances without having to carry bags of gold? This breakthrough came from merchants in Genoa and was scaled globally through the Medici Bank in Florence. It was called double entry accounting. You can think of this like a balanced scale. So every transaction is recorded twice, money coming in on one side and money going out on the other. If transactions didn't match up, then something was wrong, and this made fraud a lot more difficult, and it gave merchants the confidence to trade with partners that were further away. Imagine a king in England keeping an account with the Medici Bank in Florence. He wants to pay a Florentine wool merchant. Instead of shipping silver across Europe, the Medici simply recorded it in their books, subtracting from the king's account in London and adding to the merchant's account in Florence. The money moved on paper, not on horseback, and it made large-scale trade possible in a way coins never could. But like Rome's debased coins, banking also carried a weakness: human nature. And as the Medici expanded, managers grew careless. Some made risky loans, others committed fraud, and kings often defaulted on their debt. After the death of Cosimo de' Medici in 1464, his successors lacked discipline. Greed, incompetence, and political instability piled up, and by 1494, the Medici's great bank had collapsed. Even when banks worked, the money itself was still stuck in metals. Transaction settlements eventually needed gold or silver to be moved across countries, and this was heavy, slow, and dangerous. And by the 1600s, merchants were ready for something lighter and safer to carry. In the mid-1600s, London goldsmiths started storing coins for merchants and then issuing them receipts as proof of deposit. And at first, people used these receipts to withdraw their gold, but pretty soon after, they started trading just the receipts themselves because they were lighter to carry and way safer than carrying coins around. This was the birth of paper money backed by gold. It spread quickly, and in 1694, the Bank of England formalized the practice, issuing standardized notes tied to gold in their vaults. But paper introduced a new temptation. Just as rulers had clipped coins, governments now issued more notes than they held in gold, just hoping that people wouldn't all come at the same time to redeem it. Whenever confidence cracked, people rushed to trade paper for gold, and it sparked panics and it forced governments to pause redemptions. This pattern would continue to repeat through the 17 and 1800s, and every time it happened, it chipped away just a little bit at the promise that paper was just as good as gold. During World War I, governments faced a choice: keep their promise to redeem notes for gold or fund the war. They chose war, suspending the gold standard and widening the gap between paper and metal. In the US, Franklin Roosevelt took this even further. In 1933, under Executive Order 6102, citizens were forced to hand over their gold at $20 an ounce. Soon after, the government raised the price to $35. And overnight, anyone who had just traded their gold for dollars lost 40% of its value, while the government gained more spending power. Paper backed by gold solved portability, but repeated suspensions and devaluations showed just how fragile the system really was. By the early 20th century, it was breaking down, and the world was heading towards something very different. After World War II, world leaders met in Bretton Woods, New Hampshire to design a new monetary system. This deal worked like a chain, so gold would back the US dollar, and the dollar would back every other currency. If you held pounds, francs, or yen, you could trade them for dollars, and those dollars could still be redeemed for gold. This looks stable, but in practice, it gave enormous power to the US, since the world now needed dollars to reach gold. By the late 1960s, the US had a problem. They had printed more dollars than they had gold to back them by financing things like domestic growth and the Vietnam War. Countries like France began demanding gold in exchange for their dollars, draining US reserves. So in 1971, President Richard Nixon closed the gold window and ended dollar convertibility. Now, at the time, he called this temporary, but it never came back. This was the end of the gold standard and the true beginning of the fiat era. Fiat wasn't just another form of money, it was also a new social contract. Unlike earlier monies that were naturally adopted, this one wasn't a choice. It was enforced by a taxation, law, and military power. And as the new post-war superpower, the US now controlled the backbone of global trade. But this shift was a little bit shaky because inflation started to surge in the 1970s and confidence in the dollar was wavering. So to stabilize the system, the US struck a deal with Saudi Arabia in 1973. Oil would now be priced in dollars. So any country that needed oil, which meant all of them, needed US dollars to buy it. This petrodollar system locked in global demand and cemented America's dollar dominance. Fiat money fit the digital age at first. Things like credit cards, wire transfers, and online banking made it portable and scalable for a global economy. But this comes at a cost. Scarcity is gone, inflation erodes savings, and wealth flows upward through the banking system, concentrating power into the hands of governments, central banks, and corporations. Fiat is an experiment, and it's already starting to fail. Like every form of money before it, it solved one problem but created another. It gave us speed and scale, but at the cost of integrity. Now unchecked, money printing is snowballing out of control. Just as clipped coins ended Rome and reckless loans ended the Medici, fiat is also showing signs of decay. And as history tells us, every era of money ends the same way, with the search for something better. Like other monetary phase changes, Bitcoin was born out of the recognition that something in the previous era was failing. In 2008, the global financial system nearly collapsed. Banks made reckless bets, governments bailed them out, and trillions of dollars were printed to paper it over. On January 3rd, 2009, Satoshi launched Bitcoin. In the first block, he embedded a headline. It read, "Chancellor on the brink of second bailout for the banks." He released a new money designed as a direct response to the fiat era's failure. Bitcoin's scarcity solves dilution that is plagued every civilization from beads to paper dollars. Every unit is identical and accepted everywhere, solving the mismatch that made barter fail. And it can move anywhere in the world instantly, unlike gold that had to be dragged across continents. And its digital nature makes it immune to decay and rot like early bead or seashell monies. Every money before it failed under the same fatal flaw. The temptation to inflate, cheat, or manipulate the money supply is too strong for any human to resist. Bitcoin is different. Its rules are locked in code. The supply is fixed forever at 21 million. No king, no banker, no politician can change it. It takes the flaws every earlier system struggled with and perfects them. For the first time in history, money doesn't depend on human honesty. And this works because the Bitcoin network enforces the rules using technology that previous civilizations never had access to. The fiat system might feel modern, but with hindsight, it will one day look primitive, the same way we see seashells and beads as money today. Every form of money in history has evolved and adapted and eventually been replaced when something better came along. Barter lasted thousands of years. Coins ruled for centuries. Gold-backed paper lasted about 300 years and fiat has lasted only about 50. Just a blink of an eye in the history of money. And now comes Bitcoin, better money for the digital era. And we're lucky enough to be alive today during what might be the final evolution of money for the world. My name's Austin. Thank you so much for watching and I'll see you in the next video.